I think you're absolutely right on the global perspective, but in the real estate industry, what we try to achieve in most cases is to structure the investments through a more efficient, tax efficient ways. We mentioned earlier the OPCIs, for instance, which are actually vehicles that are tax exempt, subject to certain conditions, in particular distributions of dividends conditions, but which are very efficient. And when they are held through a Lux entity, for instance, subject to other requirements such as substance, etc., you could achieve a very tax efficient regime with a sorry.
Because presumably there are huge sections of the market where all the assets are owned in SPVs with latent capital gains. So there's going to be a liquidity issue there.
Not much, actually. I think most of those deals with very high latent capital gains, which were held directly by Lux entities, have been actually divested over the last month. We've been very active to actually somehow clean up the market. And now most of the, big tickets are either already invested through OPCIs or in the process of being invested through OPCIs. What I think the challenges is looking forward, whether that OPCI tax regime will remain in place as it is now, because it's compared to other situations, especially the other double tax treaties concluded between France and like China, Germany, etc. There's some sort of a loophole in the regime applicable to OPCIs when the OPCIs are held through Luxco. The withholding tax at the moment is 5% over distribution of dividends, so it's very efficient. And the question is more whether on the French side we will keep that regime as it is, looking forward, or whether they will be tempted to actually align that regime to the tax treatment we have with other jurisdictions than Lux.
I'd probably add where tax is less of a problem, and I didn't say it's low in France. I think it's like it is problematic, but where it's less of a problem is if you've got volume and if you're there to stay. If you're investing, 100 million plus, then the costs of setting up an OPCI, because there are costs involved, works, and then suddenly you have an extremely efficient tax exempt structure. I think investors that have had problems, or foreign investors that have had problems, are ones that are going, well, I'm just doing a quick deal, then I'm leaving, then I'm coming back, and that is tricky and problematic. So smaller investors, lower investment volumes, I totally agree. Big investors that are there to stay should be able to benefit from this structure. And as you said, if you set it up right, if I'm correct, you don't pay any income tax at all. And you have a much lower base going in. So it's a
liquidity issue to a degree. It's a changing liquidity issue for existing historic long-term investors in old SPV structures, and it's also a tax issue from the not just investor but occupier perspective. We see major multinationals looking at French employment laws, looking at French tax, and thinking, I'd rather be in the Netherlands.
I agree totally. The occupier, the occupier, that's a different story completely. And we talked about Brexit and people coming to France. If the wife of the JP Morgan, the French wife of the JP Morgan executive had her choice, it would definitely be Paris. When you speak to the accountants behind, it's a lot more difficult. The labour laws, the tax that companies have to pay, the corporation tax in France compared to its rivals isn't a positive situation. But I think the infrastructure, where Paris is in Europe, all those other points are extremely attractive. So my thoughts on the Brexit is there will be people, and some of the US banks, some of the big law firms, there will be they will look at France. Financially, they would probably rather go to Luxembourg or Dublin or areas where it's a lot cheaper. But you don't have the office space or logistics space in some of these other countries. So France should benefit, despite probably not because of some of the tax laws.